All right, guys. So our next indicator is called the stochastic oscillator or stochastic indicator. Once again, like Bollinger Bands, this was done by a very clever mathematician, George Lane, in the 1950s. Okay, so the stochastic oscillator is a momentum indicator. By comparing the closing price of a security to the range of its price over a certain period of time. Once again, you can go read up. There's massive complex calculations going into it. We're not really interested in there. What we are interested in, what is the outcome? What is the outcome of this indicator? Now, important is that what the stochastic does, it indicates that the oscillator follows the speed or the momentum of a price. And as a rule, the momentum or speed of a price of a stock changes before the price changes itself. All right? So, for instance, if you have a price and you have a mass amount of traders currently trading at that price entering the market, that will drive the momentum or the speed that the price will move down. The more, the quicker. But at any given moment, you can have a reduction of the amount of traders, but they still trade at the same price level. So let's say one trader is bidding at 51 bucks compared to 100 traders bidding at 51 bucks. It's the same price, but a vast difference in the amount of traders. Therefore, momentum and speed that will sit behind that price. So the speed and the momentum of the price of a security of a trade slows down before the price movement slows down. And this is a very, 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 very important variation. And we're going to use it to an extreme effect in all of our strategies. So what we're saying is there's a divergence, there's a difference between the price movement and the momentum, and that we know by a stochastic is that we can measure via this instrument, we can measure that the momentum slows down and the speed slows down before the price reflects the same movement. So if it's balls to the walls and it's full blown going up or down, the price and the momentum runs down. This is a typical area. Well, let me give you a nice example of that. Okay, this is 5. I want this in an hour. Okay, cool. Let's get a nice example for you. Here's a nice example. Here we've got price running beautifully, strong, long candles, just a lot of momentum, a lot of velocity. The bulls are taking over the market, and it is running. Beautiful run, right? And then it slows down here at the top to retrace. Now, what we're saying is that we can measure that the speed and the velocity of the price slows down before the movement of price changes. So in other words, before we see a divergence, a change in price going lower. I'm looking for a nice example for you. Yeah, this is a perfect one. So here we also had bear, nailing down and moving sideways and then bounced up the next day. Also not really that great example. Sorry guys, I just want to get you a nice cleaner example, and then we'll move over to spotting the other examples, which is less clean. And probably if I do this on a 5-minute chart, that's why I'm struggling to get you one, because they are much more difficult to spot on your higher time frames. Boom, boom, boom. And there we go. Here we go. Beautiful downtrend, down, reversal. There we go. Perfect section. So what we're saying is, all right, we can measure via stochastic the price movement, and we can then indicate that the momentum of the price movement has slowed down before we can see the price movement changes. So the price movement is still beautiful, lower lows, But now we say we can see that the movement has changed before the price movement, and the price movement only kicks in here when we see, hey, it's not making any more low lows. So before that happened, yeah, it was still lower lows. We are saying that we can calculate over here that the momentum has slowed down, right? And that's what the stochastic indicator does. And how does it do that? Well, very simple. We've got our swings. Guys, and let me just re-explain to you guys. I don't know if I actually have in detail explained to you what a swing is, but the swing is the market is moving up, it retraces, moves up again, it retraces, moves up again, and it traces from there to there. That's a swing. So it pulls back, picks up a momentum. That's the swing. So that's a swing. That's a swing. The market will do that again. Then that is a swing. Okay. If we look in our markets, it's moved down, pulled back, moved down. So that was a swing. That is a swing, and that is a swing. And here the swing is reversed. All right. Cool. So we see a nice bear trend, a nice bear swing coming down here. Lots of velocity, closes outside the Bollinger Band. So it's an indication of an increase in momentum in any case. The market rests, goes to the mean of the Bollinger, tests that, bounces off the 20-day moving average, a good sign. Bounces off the moving averages, in other words, it's not going over the moving average. The market's still trading below what it traded before 20 days, and hammers down. Closes outside of the Bollinger Bands, and then moves sideways and hammers down again, down to that last low of the swing, and then forms the next candle. Okay. Now, this is the stochastic indicator. 1413 is what we will be using. So let's draw a line on that swing, and let's draw a line on that swing. And what you will now see is the following, that the price, that was the last low, pulled back, and that's the lowest low. So you could see the price moved, there was the price, and it moved lower because there is the next price, right? So there's the price, swing back, pull back, and made a lower price down there. But if we look at the stochastic indicator, it has got a low here, but that low of that swing on the stochastic indicator wasn't lower. Here, that swing is lower than that swing's bottom, but here on stochastic, that swing was higher. So if you draw a line here, your slope is upwards and not downwards. So there's a divergence between the price movements, swing, peaks, and the Bollinger swing peaks. And what Bollinger says is, if there is a divergence, if there is a divergence like that, that is the precursor indication that we are measuring momentum. Remember, stochastic, we're measuring momentum and speed. This is indicating that the momentum and speed of this trend has decreased before the price movement has echoed that. The price movement only echoes it up here. You see, if you would have stayed in this trade here, it would have moved up, which is totally fine because we expect a pullback, moved up, and where do you exit? And then it will just go on to the stars. Well, if we could precursor that and realize, all right, we've got a slowdown of speed and momentum. That means less guys entering into the market, hands lifting off the keyboards, less selling, more buying, entering into the market, a slowdown, then that's a precursor of the behavior. So we know the behavior here is rock solid. Guys are selling. It's a bear trend. And then suddenly there's a change in behavior. There's a shift in momentum, the speed that the market is taking off it. Right, let me do that. Now, interesting, remember what I said is Bollinger, we're not going to use as a single entity. Well, we never use an indicator as a single entity, as with stochastic. So here we've got Bollinger and stochastic on it, and we've got price movement. So price movement has shown to us that there is a divergence, clear indication that we need to be wary or actually get out of this trend if we were in it. All right. And then the second important thing was Bollinger Band was outside of the band here on this swing. increase in momentum, pulled back, and our next swing was inside. It failed the outside. And what was that an indication of within Bollinger? Yes, oversold, but also a loss in momentum. So at this point in time, we not just have one indicator telling us one story, we've got two indicators with different mathematics telling us the same story. So at this moment, we can extract from the market that, hey, traders in the world are slowing down. There is potentially a shift in sentiment, direction, etc. And if we were in this trade, it is now time to manage our risk and get out. Yes, technically, this can still knock through all of the Bollingers, all of the stochastics, and knock the front teeth out and fall another 1,000 points. That's besides the case. The market does what the market does, because we don't know what happens in the next candle. Some news, some hedge fund dropping $1 trillion on a short, whatever. That's not important. What is important is, at this moment, this indication, this divergence, the Bollinger Bands, has shown to us that there is a clear indication in sentiment shift. So we, at this point, extracted behavior out of our chart, indicating to us it's time to leave. So let's have a look at a couple of other ones. And guys, in the beginning, it's tough to track them. I can literally drag a chart like this and spot them visually from a mile. There we've got a divergence. But the interesting thing here is that we have, here we've got, oh, it's borderline, eh? If we zoom in. So pierced there, closed there, but the high of this of the swing, eh? So that's the swing, that's the high of the swing, so that's the candle we're looking at. Just failed, didn't pierce, just failed the Bollinger Band. And now what do we have here at the bottom? We have got divergence, that's a downward slope. So let's just increase that. Ever so slightly. That's actually not a downward slope. Ooh. That's actually an upward slope. Sorry, guys. Well, it's actually horizontal, but that's a very bad example then from my side. My bad. Just said I can spot them from a mile, and I misspot that. There, well, there's one. So here we've got divergence. You've got divergence of that line there. Clear divergence between that peak and that peak. Clear divergence between that peak and that peak. Now the Bollinger at this stage didn't echo the same thing because we had a pierce and a pierce. So the Bollinger did not indicate slowdown as much as we would like. It echoed the same price movement or the same behavior, although it was on the opposite side of the band, which is an oversold area. So it's a lighter indication compared to different size where the candles break. Don't stress about that too much. Don't focus too much about that. We are looking at divergence, and we are looking at the Bollinger Band echoing what the divergence is saying. And once again, guys, I am currently viewing this on a 5-minute chart. Now, the smaller the time frame, the less authority does indicators have, all right? Because it's incredibly short. 5 minutes is ba, 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 ba. All right? If we would move this up to an hour and 4 hours and daily, then number one, you will get a lot less divergences, and number two, they have a lot more authority. Okay, so a lot of times you will. There's another one, perfect. There's divergence between that peak and that peak. So there was the up, pulled back, made a new high, hammered down. What did we have here? Divergence on stochastic. What do we have in Bollinger? Closed outside, came back, didn't do nothing, didn't even pierce it. What happened next? Ran straight down to the opposite side of the Bollinger Band. Case closed. A lot of times you'll see it come down to the mean. It tests the mean as it did here and then hammers through it. Here we've got another one. So trend going up, closes and pierce, pulls back, fails to pierce or close below. What do we have? Divergence. What happened thereafter? Markets moved down. So each one of these indications is an indication that the momentum of the market is slowed down. Yeah, we've got down, outside the Bollinger, pulls back, come back down. Didn't pierce, little pierce there, but the final swing is down here. Didn't fail, didn't pierce, didn't close. What do we have at the bottom? divergence. What happened? Ran up. What is this telling us? It's telling us that the momentum of the trade has decreased. The speed and momentum has decreased. What does Bollinger say? Bollinger says, hey, you are oversold. Your price divergence has indicated that you are oversold, and it's time potentially that this trading trend is going to lose momentum. Now, losing momentum, both on stochastic and Bollinger Band, indicates, in other words, if there's a divergence or you hit the opposite side of a Bollinger Band and moves, could only indicate that two things. Either the market is resting, getting ready for a rerun. So in other words, you are in a bear trend or bull trend, and it's resting. Only like here it was resting. Where was that other cute one I just saw? Yeah, it's resting only to rerun. All right, and actually there is a divergence here. So let's just see that. So if you look at that point there, outside, and here it broke inside, and there's a divergence here on the Bollinger, on the stochastic. So Bollinger perfect. There's a divergence. It moved sideways. It didn't change the trend. Sideways, it rested the market only to hammer through it again. All right, cool. So those are two things. It shows a reduction of momentum, but momentum decrease can mean two things. Either one, the trend is exhausted and done, or two, it is exhausted and done. The bears or the bulls are going to rest before they attack again. All right, guys, you can go through the charts and have a look. So essentially, how do we indicate a divergence? Stochastics normally follows the price. So you see there's a high. So it goes back, goes higher. So up, there, goes up. And so it normally follows. Let me just go to an hour frame. And it's easier when you track it on the hour frame. And the moment you get at the high of a peak and there's a divergence, that's our indication. And then echoed by the Bollinger Band, it's an indication of our momentum, and our speed has changed. And it indicates that to us before the price movement is changed. So we're still if you're in a bull trend, the price is going to make a higher high. But the speed and the momentum indicator is showing to us there's a shift in that. And combining that eventually with other indicators will allow us to either enter, exit the markets, or manage our exposure and risk.